everyone. Welcome to the Multifamily Dispatch. I'm Dan Gable, CEO of J+G Companies, and I'm joined by Matt Bastnagel, our Director of Marketing and Research. Matt, it's spring break season, and my email inbox is feeling quite a bit lighter. I know there's people heading to the beach, some people heading to the mountains. The Gable family, we're doing a staycation this year, so it's really just a next preview of what our summer's going to look like. What about you?
We had a similar staycation, and yes, I know that some are going to be diving right into the surf, right into the sunshine, but for my vacation, I'm going to be diving deep into the data. Right? Okay, that's my Margaritaville. Jumping into reports, economics, that's my paradise. Maybe it's the spring break feeling, but we have looked over consumer sentiment this week, and there isn't as much anxiety over the conflict in the Middle East than was expected. Now, things could change, but that's some of the data that we've been seeing this week. And also, before we get to that, since this is a multifamily investment podcast, I'm most interested really in how the investors are feeling. So what are global investors expecting for 2016? And is it bad news? And actually, if it is, just don't say anything.
It's not bad news. It's good news. First article we'll talk about is CBRE's 2026 Global Investor Intentions Survey. And here's an America First comment for you, Matt. Thank you to CBRE for the Global Investor Intention Survey, but we really only care about American investor intentions. Yeah. At least in this podcast. Okay, yeah. As expected, U.S. investors show the strongest intention to increase activity this year, with about 75% expecting to buy more. So what are U.S. investors concerned about? Well, interestingly, 61% of investors from this survey in the U.S. indicated, quote, uncertain economic outlook as a concern, with clearly softening labor market and elevated long-term rates. 26% of U.S. respondents felt that a mismatch in pricing expectations between buyers and sellers would be a big cause for concern, while only 12% indicated uncertainty in the geopolitical landscape. Perhaps this is because of the distance from the conflict in Iran, as well as our domestic oil production. I think we heard the president say at the address that he made last night.
America has plenty of gas. We have so much gas.
So I don't think people are worried too much about the issues in Iran impacting investor sentiment in the United States. As a contrast, I guess, in the survey, 47% of respondents in Europe believe the uncertain geopolitical landscape is a concern. It's important to note the profile of the respondents in this survey shows only 14% from North America, and a combined 76% of respondents are in Europe and Asia Pacific. This might be CBRE flexing its global muscle a little bit.
I think that's so much.
So while the U.S. investors are mainly concerned about the uncertainty in the economic outlook, some of this could be attributed to volatility in the treasury market. It's caused by speculation of rising oil prices, boosting inflation, perhaps keeping interest rates a little higher. But that's balanced by concerns of economic stagnation, potentially keeping a lid on interest rates, or perhaps, fingers crossed, driving them a bit lower. Last week, we discussed our view of how rising oil prices may impact multifamily investment, and the Big Green Machine, CBRE, published their estimates on the potential impact. Matt, what did CBRE have to say?
It was a more measured and less panicky assessment than I would think. But I guess it's very similar to the investor intentions in that, it's not really scaring people away just yet. Really, this article from CBRE again, it's about the potential impacts and the effects of the oil price increase on real estate values. And it really is just a little brief note. And since this is a multifamily podcast, I want to skip to those numbers. If oil prices go up 20%, U.S. multifamily cap rates go up 7 basis points. If oil prices go up 40%, multifamily cap rates, and this is in the U.S., go up 14 basis points. Not a huge huge jump. I've seen, you know, I think we've probably seen that movement outside of Middle Eastern crisis. So it's nothing to be, again, like nothing to be panicky about, but there will be an impact. I don't think it's worth ignoring what's happening or just kind of trying to pace it over and do business as usual, because frankly, I think that's probably impacting a little bit of investor sentiment and just putting a damper on things right now. But the upshot to all of this is that probably all told, the impact won't be incredibly bad for real estate values. I think there's a lot of anticipation of like, all right, this is a bump in the road. Let's get past this. I know that I've seen in the news that all the discussion is like, well, if this goes on any longer, then XYZ is going to happen. And everyone's looking for this to be temporary. And it's like, it's almost frustrating how we just don't know I don't know where it's ended, but it seems like the assumption is that it's going to be shorter than longer. But elsewhere, though, and this aligns with the investor intention survey, European CRE valuations get hit harder. So Europeans, their residential, their multifamily cap rates would increase 17 basis points as opposed to our 14 if oil prices went up 40%. And then 9%, it would go up 9 basis points as opposed to our 7%. So just a couple basis points difference between European and in US valuations. Recent data, though. So again, yes, there is a sense that for multifamily and for arguably the economy as a whole, we were really finding our footing, I think. There was a sense of maybe stability in spite of or because of, let's just, whatever your politics is, tariffs and all of that. There was a resilience underneath the economy, and that has been a little bit disrupted by the conflict in Iran, but not necessarily, hasn't really been flipped over or completely, demolished. So that's good to know. And it's not just me saying it, because there have been recent reports on consumer sentiment, both from University of Michigan and from the Conference Board, that would support this idea that I'm just throwing out there, that maybe the economy is stable. Well, I'm not the only one thinking that. So I feel a little bit better. So yeah, let's just get right to the consumer sentiment. We'll start with the conference board, and then we can go into another great source, which is from University of Michigan. For both of these, again, I was surprised actually, because it has been, for the past 3 years, it's been the story of the vibe session. Why is everyone bummed out? The labor market isn't too bad. It's, historically, the unemployment hasn't been horrible, but people have been feeling worse than, according to some measures, worse than they were feeling during the Great Recession. So it's always been, the Trump administration was very confused about this. And then before that, the Biden administration was very confused about it. Why aren't people feeling better? And now we have a clear oil shock. Oil prices, speculated to go up 20 and 40% just in that CBRE. This is what people are thinking about, but people aren't worried yet. And I think that's really interesting in an environment where it seems like at the drop of the hat, people are ready to get bummed out about the economy. People are bummed out and they're not panicking just yet. Again, maybe in a month this is going to change, but I'll show you where we stand, and we'll start with conference board. Okay. So conference board, the consumer confidence went up just by a little bit, 0.8%, but I'll take it. The present situation index improved by 4.6%. Now, again, some of this data was collected after the conflict in Iran. So you'd think that if there was huge panic, that we wouldn't see that present situation 4.6% up. But the expectations ticked down a little bit by about half that amount. And the quote that they have here, the pullout quote is, while obviously not in the headline or component indexes, the weight of rising costs due to tariff pass-through and spiking oil prices was evident among other measures in the survey, like inflation expectations. And so we'll scroll down to those inflation expectations, and you'll see how big the jump is. See, you know what I did? I didn't even read the words. I looked for a graph that had a big spike at the end, and that's inflation expectations. Whether it's the average inflation rate or the median inflation rate, those expectations jumped up by about 15 to 20%, but really so they went from expecting 4.5% inflation to maybe 5.25 inflation, something like that. So it's a big jump, almost a 4% jump in the inflation expectations, since the beginning of the year.
because inflation expectations beget inflation. Expectations are very important to manage here.
And that's what I remember hearing this in like 2022, and how some of these countries were battling the expectations themselves, and we discussed that just last week about how the Fed's part of the Fed's job is this communications role to make sure that people that it's not this feedback loop. So yeah, I think that's really important to keep track of. We didn't have time to include it, but the New York Fed keeps track of this, and they're also seeing increased inflation expectations. So that, I'm sure, will bleed over to the sense of the entire economy if things go overboard. But for now, it's super clear that we haven't gotten to the point where like oil prices or fertilizer shortages or whatever second, third, and fourth order effects and treasuries are one of those, have on the economy. That just kind of hasn't hit the everyday consumer yet, according to the Conference Board. But let's just jump into University of Michigan. They have had historically a little bit lower consumer confidence readings, or consumer sentiment is what they call it.
They're more pessimistic.
Yeah, a little more pessimistic, but there is, now I'm going to try to on the fly here, go to the index of consumer sentiment. We can see in the last 10 years. And so what happened in 2025 was a methodological change in which they changed from paper ballots basically to electronic internet surveys. So middle people, I'm guessing, made it easier for them to process and for people to fill it out. But for some reason or another, that also coincided with a real meaningful drop in consumer sentiment, such that it's like, here, let me pull up the 50-year so we can compare this to the Great Recession. This is what I was mentioning for right now. So right now, our consumer sentiment is lower than at any point during the Great Recession. I just don't think that's right. And now, again, let's go back to compare to the Conference Board's data, and you can compare this to the Great Recession. We are well above. We're about, let's see, 40 percentage points, maybe 30 percentage points above the Great Recession. That seems more that seems more understandable to me. I lived through the Great Recession. It wasn't a great time. I felt a little worse during that time period than now. But I don't know. Maybe it is worse. There's certainly, this is affecting different people in different ways. And it's true that there's reasons to be a little worried. But again, like I said, for this whole discussion of consumer sentiment, it just hasn't been that bad. The quote here from University of Michigan specifically said, overall, the short-run economic outlook, that went down by 14%. But their longer-term expectations were actually more flat. So they say these patterns suggest that at this time, consumers may not expect recent negative developments to persist very far in the future. So again, at this moment, and this survey and Conference Board, they both captured a little bit of the beginning of the Iran war. At least the hopes are not so dismal. So there's something, or I'm sorry, the sentiment's not so dismal. Yes, again, this data is a little bit early, a little bit fresh. So we may need another month to get the complete picture. But now it's not as bad as you think. If I could have a theme for this week, it's like, well, maybe it's not as bad as you think. All things considered, it's not so bad. Yes. So again, we've spent that long time thinking about the Vibe session and kind of trying to translate this into consumer sentiment. I do think that the Vibe session is an important contest with which to measure the current sentiment. So in an environment where it's very easy to feel bad about the economy, people aren't feeling that yet. So I think that's a good thing. And I think it shows a little bit of resilience in the economy, or at least according to people's perception. That's just people. People are dumb animals, right? If I want to look at the economy, I look at the economists and the experts. And that's a big question I'm asking you, Dan, is what are the real smart people saying?
Well, Matt, the ULI asked just that question in their article, Is Stagflation Returning? So let's play a game. It's called Ask the Experts and pick which one you like best. Okay, I'll go through kind of lightning round of all these experts and what their take is, and then we'll choose which one we like the best. First up, Thomas LaSalvia from Moody's Analytics. He puts the probability of a period of stagflation at 20 to 40%. He also says a period of stagflation would create mounting stress in the multifamily and retail sectors as household budgets get pinched, and these challenges collide with a difficult refinancing environment as the Fed's ability to lower rates would be constrained. Pass. Michael Acton with AEW, he says stagflation is not their base case, but it isn't a tail risk either. He sees modest economic growth rather than meaningful contraction and predicts a lower growth, higher inflation, higher interest rate environment. It sounds a little bit like stagflation to me. But he also goes on to say, less differentiated residential real estate may feel pressure as near-term rent growth flags inflation. Okay, strike two. Next up, Victor Kalinog with Manulife Investment Management. He strikes a more positive tone. He notes that inflation has largely moderated, and while growth is slow, unemployment is still under 5%. He cautions that investors should stay informed and recognize where risks are being mispriced in the market, leading to opportunities. I like his optimism.
Yeah.
Now for someone a little closer to real estate, John Chang with Marcus and Millichap notes that the risk of stagflation remains low, but if stagflation occurs, commercial real estate is positioned to outperform most other investment options due to its inflation resistance. He also mentions that commercial real estate could increasingly appeal to investors as an inflation hedge with relatively durable returns in a recessionary cycle. Okay, he's biased, but now we're talking. All right. Then Sam Chandan with the Chin Institute for Global Real Estate Finance at the New York University Stern School of Business. Kudos for the longest title ever. He echoes comments we made last week about how inflation risks remain tilted to the upside, while risks to employment have shifted to the downside, making the trade-off across the Fed's dual mandate more pronounced. Yeah. He notes this does not appear to be a replay of the 70s, noting that today's inflation pressure appears to be coming from supply-side disruptions, which is very different than demand side. He also states that policymakers have to determine how far the economy is from each objective, price stability on the one hand and full employment on the other hand, and use their, quote, single blunt instrument, that is, raising or lowering interest rates, accordingly, even though it cannot offset both sides at the same time. Yeah. Sam gets my vote. Okay. Makes sense. Finally, Chad Wattell with CoStar, who completely dodges the first question by stating that, why are you asking me? The Fed doesn't expect the economy to fall into stagflation in the near term. But he does go on to answer the theoretical follow-up question, which is, predicting stagflation would show up in commercial real estate as margin compression first, and offers that short-term leases can be a liability if rent growth remains weak, but long-term leases can also be a liability if contractual rent growth lags inflation. So, Matt, which one's your favorite?
Okay, so you're making this tough because I've been a big fan of Thomas DeSalvia at Moody's for years. I've called the Moody's CRE research department the LaSalvia School, or at least I tried to make that term take off. And I'm still trying, but we'll see. LaSalvia seems to have the highest expectation of stagflation, or at least he's the one that's most willing to kind of say the word. But a mere 3 weeks ago, his team was actually a lot more optimistic. They titled one of their webinars, they talked about the positivity of 2026. And they said 2026 is opening with greater clarity and a more constructive outlook for commercial real estate. So that was 21 days ago. Things have changed a lot, I know. But I like to think maybe there's still like a nugget of optimism in the LaSalvia school, but we'll see. Prospects brighten, they said. Optimistic forecast for 2026, they said. Again, I'll hold out for a fuller take from the LaSalvia school as this develops, but I don't think we're that close to stagflation at the moment. John Chang, I think he always skews very hopeful on the other side, but he's at least consistent in his perspective on the strengths of the CRE market. I think that guy with the long title, Sam Chandan, has a nice measured take. Yes, bad things could happen, but it won't be like the 1970s. But also tariffs could make the Fed's job harder. I do like to return back to John Chang. I like how he did note how CRE is insulated against some of these economic shocks. And inflation could be one of them. And the other experts didn't necessarily mention that. So I kind of like John Chang's take along with Sam Chandon's realistic take on the present economic moment. And we saw this during the pandemic. Yes, a lot of assets did horribly, but in a situation where everything's going down, where it is a recession, a downturn, a correction, whatever, you have to look at the relative value for things and how things are relatively performing. Because if you're talking about like investor appetite or whatever, if real estate's doing better than the stock market, well, then that's a great sign for real estate. And I think that it probably will, just because it moves a little slower and it's less volatile in just inherently. But yeah, so that's my take. A little bit of it was a cop out. A little bit of Sam Chan and a little bit of John Chang. I think that there's a lot of insulation in the CRE market.
Yeah. So we've heard from these experts on the risks to the economy right now. Matt, you feel like maybe there's another part of the economy that's worth discussing that I don't think anyone's talking about?
Oh, yeah, I know. In all of this discussion of like the uncertainties and volatilities of the economy, on the edge of everyone's lips, if we weren't talking about Iran, if the Iran conflict was strangely enough just not present, just didn't happen, I think that people would be still talking about data centers, AI, artificial intelligence, OpenAI, call it what you will. I just want to add that to the potential risks and economic risks. There's a lot of upside that could happen. There's a lot of great things that will happen because of AI. And this article from BizNow is called Data Center Transparency, Operating Concerns Raise Alarm in Ballooning CMBS Market. Now, this is just the concern side. This is what the risks could be. And I was talking about this before, kind of trying to go over some of the material that we were going to cover today. And I'm trying to kind of articulate it, and my articulation is like, well, yes, good things are happening, but if let's just say you put a data center in Abilene, Texas, and for some reason or another, things go bad, is that priced into the loan, and what is the risk of that? And I keep thinking about like what $1.6 trillion or however much that figure is that's going to be invested in the next few years, or is already invested, I don't know, depending on what people's calculations are. That's a lot of money that's invested. And a part of me thinks, is that all really going to get built out? Or is the money going to find its way back somewhere? Or is it all just going to be sitting in a warehouse in NVIDIA chips? I don't know. But this article kind of addresses some of those concerns. And my hot take is that all those data centers aren't going to get built, but we'll get to that later. And I know you have thoughts about it. Again, I've seen a lot of exciting software reveals from the Vibe coders. And while I sometimes wonder if the AI investment is kind of subsidizing the operating costs, and maybe the subscriptions would be higher if it weren't for the investment, like all of those early apps where you get like free for a little bit and then they'll charge you up, like Netflix, whatever. But so I think actually the more interesting question is not how much they're going to charge. It's more of like, how much of the $1 trillion plus investment in AI infrastructure will actually be built, and what happens maybe if things go wrong. And it's interesting because the circular kind of investment and the strange accounting, I was listening to Bloomberg this morning, and they mentioned that they were like, what is the risk, the depreciation risk of these AI centers? And in the same breath, they mentioned how this just seems like clever accounting. And I looked it up. I tried to understand it. I got a little bit of a brief. So here's how I think. So Microsoft invests in CoreWeave data centers. Then OpenAI pays CoreWeave to use those data centers, but OpenAI is also an investor in CoreWeave, so that's good. Then CoreWeave has to buy a bunch of NVIDIA chips to run their data centers, but don't worry, because NVIDIA also invested in CoreWeave, so that NVIDIA investment money goes right back to NVIDIA. Oh, yes, and also NVIDIA invests in a bunch of OpenAI too. So it's just, they're all kind of seeming like paying each other, and the money would come back to investors, maybe in terms of like stock appreciation, but revenue wise, it seems like the outlet for that money is basically on OpenAI and Anthropic through like whatever subscription models, or whether it's personal or business. Wait, enterprise. Sorry, I used the wrong word. Subscribers though. And according to JP Morgan analysis this January, you'd need to get to $650 billion in revenue for a 10% return on recent data center investments, which they say is equivalent to having every iPhone owner pay $35 a month. You can slice and dice that in $650 billion. Okay. Well, we can, yeah, a lot of money. We can divide it by the iPhone owners or whatever, but it's a lot. My point is, however, though, is like, there's a chance that AI companies don't get that many subscribers. And the question is, what happens to the data center that you've just finished building, or that like you're in the middle of building and it's like, oh, we don't have that demand? What happens? I don't know. One of the points in the article, just to go back and actually talk about the article, is that if you've borrowed money to build these things, that borrowed money may be a little riskier. I think they note in the article that it's because of the closely guarded technological secrets that it's hard for lenders to get a good idea of what's going on and how complicated the data centers are. It's harder for lenders and services to even kind of think about taking over the property. This is according to the article. And lenders and investors should have an idea of the risks to investment. AI is not going to flop, but there's going to be some risks in all of like the complicated nooks and crannies of the AI business. And I think it's also predicated on a kind of future AI success that has not necessarily been fully fleshed out. Like, I think that all the AI companies are not willing to say it, but they're all kind of saying, well, yes, we're going to replace all workers. That is the ultimate, is like, that seems like where it's heading. But again, the clear cut right now, they are making money from a subscription service, and that's the income. And I just wonder where it goes from there. But again, all of this complication and the complexity, whether it's the vague future or it's just the complexity of the technology inside those data centers themselves, they have obscured the risk, according to this article from BizNow, and this obscured risk is to the benefit of the borrower. And my favorite quote in the article was, intense operating needs could give borrowers an advantage over inexperienced lenders or servicers in reporting negotiations. And then I just had a little role play. So you can be the lender. Hey, just give me the loan. I'm going to build these magical technology things. We're going to get this water hookup here. We'll get some solar, maybe run a little nuclear power. And listen, a lot of these stuff I can't even explain to you because of national secrets. So you just trust me. You could probably just give me the money right now. That's how I imagine those loan discussions go. But yeah, I'd love to know how you think. And you shared some information about how maybe some of these concerns over the risks may be a little bit overblown.
I think so, Matt. So, I mean, first, a lender is going to try to understand everything they can about their borrower, right? And so I think it's really important that we bifurcate what they're lending on. Are they lending on the CapEx, machinery, the equipment that's going into these data centers? Or are they lending on the real estate? And if it's lending on the real estate, I would think that any responsible lender would look at this like a light switch, single tenant type scenario, where you have to make sure that your loan is paid down to the land value by the end of the term, so that you're not sitting with an empty building 5 years from now, upside down and in value. Okay, so my guess is that most lenders lending on the real estate portion, not the CapEx, are going to look at it that way, take a land value scenario and say, we'll give you low leverage. And my old gut is that most of these companies are sitting on so much cash that they're funding the CapEx. I don't think there's a huge concern.
So, and we spoke about this before. I thought it's really interesting. You seem to think maybe that like these lenders, it's not that they're actually used to taking this complicated stuff. And I was thinking just now, but what if it's a big medical lab that has a bunch of specialized technology too? But so they know that basically like, we're not going to be able to figure out a way to have a secondary use after this. We will treat this as like, well, at the end, if you default, we'll get the land back, and that's how much we'll borrow for it.
And not just that, but at the end, if you default, we're going to lock the doors, keep your CapEx equipment. So not only do we have the land, we have the shell, right? We have all these NVIDIA chips.
Okay.
Right? Or all the equipment that's in there, right? So that's how, as a lender, you protect yourself from a light switch type thing.
Yeah. I think there's going to be a lot of NVIDIA chips just laying around. I can't wait. 5 years from now, we're going to be swimming in it. Hopefully. I just want a cheaper computer. That's what's selfish of me. But yeah.
Yeah, there you are. I will take the other side of your question here, though, and say, the data centers will get built. The question is where, right? And so if we go back to the first article, we can zoom out and you can see in there that the data centers in the U.S. are number 6 on the list of preferred real estate sector investment, but number 4 on the list in Asia Pacific. So if the U.S. keeps this NIMBY attitude toward data centers, I think they get built in Asia, where public sentiment is more positive toward AI and data center development. Is there an AI bubble? Perhaps. I'm certainly dubious of the overall makeup of the Mag 7 and stock indexes and the circular economy you're talking about. Am I completely out of the stock market? No, I'm not. But I've adjusted my personal positions to reflect that risk. And yeah, this is one of the reasons that I'm such a huge believer in hard assets like real estate.
Yeah, I agree, and I think you're very right about the NIMBY opposition to data centers in the U.S. and the more favorable conditions in other countries. That was something that I didn't think of before you responded. Like, oh yeah, it doesn't always have to be in the U.S. I do wonder if there is some, if the push to have them in the U.S. has something to do with kind of like national security or something. But that all being said, if and we see it in Indianapolis. Every time the data center goes up, there's protests against it. And so there's a little bit of a push-pull. But I also think there's a little bit of risk here that maybe not all lenders or investors know about. So as a part of the Multifamily Dispatch, I feel a responsibility to inform our listeners every week about the positive trends and potential risks, whether they're in the broader economy or in the apartment market specifically. And we take in this information, all these details, as complicated as a hyperscale gigawatt yottabyte data center, and we distill all the most important ideas of data every week on the podcast and in our excellent newsletter, which you can sign up for at themultifamilydispatch.com. This was an excellent episode, and I really thank you. So
absolutely, Matt. Thanks. We are here to break down the data each week, even if it is spring break. So thanks for listening. Stay safe, and we'll see you next week.